While energy prices have risen, I'm going to show you why they are about to go much higher. This is for the United States, but of course, I'm going to talk about the whole world. Here we go. Right here, global gas ship shortage sends vessel rates surging to a record. Shell books ship at equivalent of $400,000 per day to carry U.S. gas. Lack of ships presents new risk to gas supply this winter. Really quick note that I wanted to make here was that what we are seeing is that these ships carrying natural gas going from the United States are moving that to Europe. Europe dealing with, of course, the Nord Stream 1 pipeline being shut down, reductions coming from Russia in general have left Europe with less gas. We know that this is a whole debacle and everything. I've been covering that so long, but just want to make it clear what's happening here. The gas for you, Americans, it's leaving your country and it's going to Europe. Now, this is also happening where we see the actual strategic petroleum reserves being depleted significantly at the same time. I do believe that this is going to impact the prices that you pay right now for your energy as you move into the winter. Let's look further in here. A rush to secure natural gas is resulting in an acute shortage of seaborne vessels, forcing companies to pay record high rates to transport fuel to Europe. This is unbelievable, right? The continent is racing to replace Russian pipeline flows with liquefied natural gas from suppliers, including the US and Nigeria. But there are few ships available through the rest of the year, presenting a new risk to the global gas supply this winter. So this is going to impact everyone. As you can see, it isn't just the United States or just Europe, but we're looking at this all over the place. Higher prices to be paid. Now, this is one aspect. I'm going to show you a second in just a minute. Stick with me. Here we have it. Buyers are snapping up all available vessels as demand for gas increases with winter approaching and refraining from releasing any back into the market in case they're needed for any supply at short notice. These two deals were done last week, and it basically just talks about the $400,000 and $360,000 per day. Now, this is quite high. You're looking at the prices that we are seeing right now, just comparing. It is significant. These are always in flux, but just showing you that they have spiked recently. Let's look at the next one. KeyBank warns investors of a trucking winter amid anemic economic conditions. Now, in one hand, I'm just talking to you about freight for natural gas, moving that from these vessels over the ocean into Europe. And those are nearing record highs, okay? And then you have this with trucking being the exact opposite. But 2 years ago, or even 1 year ago, what were we talking about over and over here on this channel? It was that there are trucker shortage, we need more containers, we need everything. We just need everything. Anything that was there, we needed more of it. What's happening with semiconductors today? Suddenly there's too many. Look at what Nike did. Look at what other companies, Walmart, Target, all these things. There's this glut of inventory. What happened here? So different in such a short period of time. What was that one change that occurred between this year and last year? I'll let you guess. Put it in the comments down below, please. I'd really like to know. What was that one big change that affects basically everything from last year into this year? Please put that in the comments below. We'll see who wins. Janet Yellen is going to give you a prize if you are the winner. Here we have it. Okay, so let's look a little further if we can. I just want to show you what happens here. This is an interesting article, to say the least. Get ready for the trucking winter. KeyBank's Todd Fowler and Carney Blake, who are the group's air freight and logistics analysts, wrote that freight activity has been, quote, seasonally weak. And what's so unusual about this is that this is moving into the fourth quarter of the year, where generally it would be really ramping up right now. And that's air, that's train, like anything that you can think of. This is starting to ramp up. Instead, seasonally weak. There's been limited indication of the typical peak season activity that carriers and shippers expect in the fall as retailers prepare for the holiday season. Something that I deal with regularly. When you sell products online, you got to start early. Like, if you want that stuff to be there for that Christmas season, you need it to be there. Like, you need to start moving it now. Okay, that's the way it goes. And yet, they seem to have no trouble today. For public trucking companies, they expect the results for the third quarter and estimates for 2023 to be weaker. So unusual, right? And why? Well, they talk about having too much. Too much. Given macro pressures to slow economic demand and the potential related impact on freight activity, we are more inclined to prepare for a trucking winter before a trucking spring. Now, of course, they do go on with this and talk about the details of it. The point here is that they seem to have too much. And what's so unusual is that it seems like just yesterday that they had not enough truckers, not enough containers, not enough trucks, not enough training, nothing. They had nothing. And now suddenly too much. It flipped like that. So strange, to say the least. Now, this is what happens when energy becomes this is the extreme. Total blackout. World's biggest ever blackout as 140 million people plunged into darkness in Bangladesh after mystery power grid collapse. Hopefully we can find out what happened here as a result, but just understand that mass blackouts can happen. It doesn't have to be in Bangladesh, it could be anywhere that this can happen, okay? Please understand that, and that's why we must be prepared. Here's the reality of the situation, is that people today are living paycheck to paycheck. 60% of US consumers have cut their spending due to inflation. And they show you the data. 28%, this is in the point form notes if you could read that. 28% is the share of consumers earning more than $200,000 who live paycheck to paycheck. Let me repeat myself. $200,000 a year, they're living paycheck to paycheck. How much of that is the percentage? 28%. We are not far off from 1/3 of people. But you know what? I've seen the stats, and they go on and on. It's basically the same thing. No matter what you get paid, you are going to live paycheck to paycheck. That's the vast majority of people. And what's happening? Coming around the corner, it's not looking good because robots and automation are going to be there. So there's going to be layoffs at some point. Understand this. Layoffs will happen at some point. It's this year, it's next year, it's 5 years, whatever. When those layoffs happen, usually what happens is that they start to hire more people. However, in this great transition, as we rapidly move over to robots and automation, people will not have that time and ability and funds to be able to retrain themselves to have a different career, different perspective, and so on. So they will not be hired back. And they will, unfortunately, for so many, be in a very troubled spot. That's the way it goes, okay? Look here. You can see it for yourself. Robots are making French fries faster and better than humans. Fast food French fries and onion rings are going high tech thanks to a company in Southern California. This is Miso Robotics. I think I've shown you here. That's right, Flippy 2. Flippy 2. Okay, I haven't shown you what it looks like, but this article doesn't have the pictures of it. I'll try to bring it to you. So we've got Flippy and now Flippy 2. And by the way, they're working at different places. The one that I saw, Flippy 1, was White Castle, and another one. Chipotle now has Chippy, and I'm not making these things up, this is real. Chippy, and Chippy is that robot that is working on the tortilla chips. Now you might say, I don't want to, flip burgers and fries and tortilla chips and all this, but of course, that's the way this goes, right? They start in one area where the jobs can easily be replaced, then they go to another. But it's also affecting higher incomes as well because the robo-advisors are becoming a very real thing. Robo-advisors, okay? Financial establishments are implementing this today. Okay, here we have Australia supercharges market debate that peak rates are near. Why? Because they increased their interest rates at 25 basis points. And that was considered to be extremely dovish. As I record this video, the Asian markets are looking strong. You can see that, we deal with this all the time where it flip-flops back and forth. But ultimately, markets want to see this. They want to know, oh, the central banks, they're about to pivot. Well, speaking of which, the Fed put is the belief that the central bank will step in to backstop the markets if there's a swift decline. Bank of England's emergency response didn't fix the underlying problem, which is the highest rate of inflation in decades. If the Bank of England put were to fail, or the next test of a central bank put, the risk is that it's akin to the Bear Stearns moment of 2008, causing investors to further question central banks' ability to provide protection in the era of high inflation. This may come and only time will tell, but watch very closely how the market reacts to the actions of the central banks. Very key, very important here at this time. UK property funds limit withdrawals as pension funds shift assets. You know there's a problem when they say, uh-oh, can't get your money out. Now that fund, the way that it looks from the outside, you might say, well, it's stable, it's fine, it's great. Yeah, because people can't get their money out. If they could, they'd be redeeming. That's why these companies do what they do. Please understand that. Really quickly, central banks are buying gold right now at this time. Okay, we've seen the accumulation all along. And I have to ask this one question. If a central bank could print unlimited amounts of money, why in the world would it buy gold? That's the question. Think about it. What is the purpose? Ben Bernanke didn't seem to know. Maybe my wise subscribers have a better response than Ben Bernanke. The Ministry of Finance, this is in Russia, by the way. The Ministry of Finance plans to allow international settlements in cryptocurrencies for any industry. For any industry, no blackouts, no restrictions, no nothing. They're allowing it. Why is this the case? Well, it's very clear that they have to in one regard, because they're saying, look, these things are being restricted from us, we can't deal with it and so on, we're going to have to go a different route. And whatever the case may be, we want to make sure that the roads, the pathways, the laneways are open for business so that we don't restrict our own economy. Now, they might change their tune later on, but right now that's what's happening. So here we have it. We see the financial system on one hand, we look at the economy, and we look at what's going to happen. For you, the individual, you must understand that power prices will likely be rising unless there's some sort of massive shift in demand. If that's the case, different story. But you, the individual out there, what can you do? Can you get a fixed price for your energy right now? Is it too late? See what you can do. Call them up. Say, I got financial hardship, I got issues, I need a discount, I need a loyalty discount, I need a, I'll do what, do you have a promotion, something. Try to get that to happen for you. Your food prices, everything, they're all rising now today. Whether it's because of fertilizer, whether it's because of shortages, whether it's because of some chaos that's happening, please understand that we cannot hope that things will change. Look at what's going on. Look at the data I have shown you today and understand how serious this really is. So, if you appreciate this message, I want to thank you for being here today. And don't forget to subscribe. I'll see you on the next one. Take care.